Booyah! Welcome, investors, to the greatest show on earth, the stock market. This isn't just some stuffy club for old guys in suits. No, sir. This is where dreams are made and fortunes are won. The stock market is a giant marketplace. But instead of selling apples or cars, we're trading tiny pieces of companies. These pieces are called stocks. When you buy a stock, you own a part of that company. You're in the game. Now, the market has two main moods. It can be a wild party, a real barn burner, or it can be a total train wreck. We have names for these moods. Let's talk about the good times first. We call this a boom or a bull market. Think of a powerful bull charging forward. That's the market when it's booming. Stock prices are climbing higher and higher. Everyone feels like a genius. Your favorite tech company's stock is up. The company that makes your sneakers is up. It seems like every stock you touch turns to gold. Money is flowing, people are confident, and the headlines are all positive. It's an exciting time to be an investor, believe me. You feel like you can't lose. The energy is electric, and everyone wants a piece of the action. But what goes up can come down, and sometimes it comes down hard. This is the bust, or what we call a bear market. Picture a big bear swiping its paw downward. That's a bust. Stock prices fall fast. Suddenly, the party is over. The music stops. The stocks that were making you rich are now costing you money. The news on TV turns scary. People start to panic. They worry about their savings, their retirement, their future. A bust can happen for many reasons. Maybe the economy gets sick. Maybe a big company has terrible news. The mood on Wall Street gets very, very gloomy. So, what causes these massive swings? Let's use a simple example. Imagine a new company that makes amazing electric skateboards. Everyone wants one. The company's sales are fantastic. Investors get excited. They all rush to buy the company's stock. This high demand pushes the stock price way up. That's the start of a boom for that stock. But then, a report comes out. The skateboards have a battery problem. They might catch fire. Suddenly, nobody wants the skateboards. Investors get scared. They all try to sell the stock at the same time. This panic selling makes the stock price crash. That's a bust in a nutshell. The stock market isn't just about numbers and charts. Oh no, it's driven by two of the most powerful human emotions, greed and fear. These feelings are what turn a small price change into a massive boom or a terrifying bust. During a boom, greed takes over the driver's seat. You see your neighbor making a killing on some hot new stock. You hear stories on TV about people getting rich overnight. You get that feeling, the fear of missing out, or FOMO. You think, I need to get in on this. I deserve to make that money too. So you jump in, maybe buying more than you should. This greed creates a feedback loop. When everyone is buying, prices go up. As prices go up, more people get greedy and buy more. It becomes a self-fulfilling prophecy. People stop asking if a company is actually worth the high price. They just buy because the price is going up. They're chasing the momentum. This is what we call irrational exuberance. It's a frenzy. Everyone is high-fiving. The financial news channels are cheering. It feels like the good times will never ever end. But you have to remember, trees don't grow to the sky. No stock goes up forever. Then, the mood shifts. Fear creeps in. It might start with a small piece of bad news. Maybe a government report shows the economy is slowing down, or a big important company announces lower profits. Suddenly, the greed turns into fear. People start to worry. They look at their huge profits and think, I need to sell now and lock this in before it disappears. The first wave of selling begins. This pushes prices down a little. Seeing the prices dip, more people get scared. The fear spreads like a virus. It's the opposite of FOMO. Now, it's the fear of losing everything. That fear can quickly spiral into outright panic. Your portfolio, which was bright green, is now flashing red. The smart, confident investor you were a week ago is gone. Now you're just scared. You think, I have to get out. I have to sell everything before it goes to zero. When thousands of investors think this way at the same time, it creates a massive wave of selling. This is what causes a market crash. People aren't thinking about a company's long-term value. They are reacting to the terrifying emotion of fear. They sell everything, good and bad. This is when the real damage is done. So, you might be asking, Kramer, why does this have to happen? Why can't the market just be calm and steady? Great question. The answer is that the stock market is tied to the real world, and the real world is always changing. Think about it. Companies are run by people. Economies are affected by big events, and investors are emotional creatures. All these things create constant motion. One of the biggest drivers is the health of the economy. When the economy is strong, jobs are plentiful, and people are spending money. This is great for companies, and their stock prices tend to go up. But when the economy gets sick, like during a recession, the opposite happens. People lose jobs. They stop spending money on new phones or cars. This hurts company profits, and their stock prices fall. News is another huge factor. A surprise announcement can send a stock soaring or sinking in minutes. A company could announce a breakthrough new product. Booyah! The stock takes off. Or the government could announce new regulations that will hurt an entire industry. Wham! Those stocks get hammered. The market is constantly reacting to new information, good and bad, every single second of the day. Another key ingredient in this mix is interest rates. I know it sounds boring, but listen up. Central banks, like the Federal Reserve in the United States, set interest rates. This is basically the cost of borrowing money. When interest rates are low, it's cheap for companies to borrow money to grow their business. It's also less attractive for people to keep their money in a savings account. So more money flows into the stock market looking for better returns. This pushes stock prices up. But when central banks raise interest rates to fight inflation, borrowing becomes expensive. Savings accounts pay more. Money flows out of the stock market, which can push prices down. Finally, we have to talk about investor behavior itself. The market is made up of millions of people, all making their own decisions. As we discussed, these decisions are often driven by emotion rather than logic. This collective psychology can create trends that have nothing to do with the underlying value of a company. Sometimes a stock becomes a meme stock and goes crazy because of social media hype. Other times, a false rumor can cause a stock to crash. The market is a complex living thing that reflects all our hopes, fears, and sometimes our craziness. That's why the roller coaster never truly stops. All right, you've learned about booms and busts. You know about greed and fear. Now for the million-dollar question, what do you do about it? How do you survive the roller coaster and come out a winner? The first rule is homework, homework, homework. Never ever buy a stock just because someone else is or because it's going up fast. That's not investing, that's gambling. You need to understand what the company does. Do they make a product you believe in? Are they making money? Do they have a strong plan for the future? Owning a stock is owning a business. Know what you own. The second piece of advice is to think long-term. Don't be a trader who jumps in and out of the market every day. That's a recipe for disaster. The real money is made by owning quality companies for years, not days or weeks. Market booms and busts will come and go. They are temporary storms, but over the long haul, the stock market has always gone up. Your goal is to ride out the storms. If you own a piece of a great profitable company, a market crash is just a temporary sale. It's a chance to buy more of that great company at a cheaper price, if you have the cash. My third tip is one of the most important: diversify. In simple terms, don't put all your eggs in one basket. Don't bet your entire life savings on one single stock, no matter how much you love it. If that one company gets into trouble, you could lose everything. Instead, spread your money across many different high-quality stocks in different industries. Own a piece of a tech company, a healthcare company, a bank, and a company that sells consumer goods. That way, if one part of the market is having a bad day, the other parts can help balance out your portfolio. Diversification is your seatbelt on the market roller coaster. Finally, have a plan and stick to it. Before you invest a single dollar, decide what your goals are. Are you saving for a house in 5 years or for retirement in 30 years? Your timeline matters. During a scary bust, when your gut is screaming, sell, go back to your plan. Remind yourself why you invested in these companies in the first place. Don't let the panic of the moment derail your long-term goals. Booms and busts are a normal part of the investing journey. By doing your homework, thinking long-term, diversifying your holdings, and staying disciplined, you can navigate them successfully. Now go out there and make some money.